the increase in China's reserves over the last 12 months, 80% of that increase has come from gold itself. A mixture of buying gold and the rise in the gold price. Now, what that's saying, China is buying gold, and gold's at an all-time record. They are valuing gold more than any other asset they could buy. So I think other central banks are taking notice, and it'll take a long time for central banks to react to this. That's why the gold price is rising, despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East. People are saying none of that matters, because what really matters is, what am I going to get back if I go for the other thing?
The bank expects China's demand to recover after falling in the second half of last year. The country's pledge to use easing monetary policy and fiscal expansion to boost economic growth is likely to support physical gold demand. China was the biggest central bank gold buyer in 2023, but stopped announcing increases to its official reserves in May. Even with the pause in public reporting last spring, China still admitted to adding nearly 30 tons of gold to its official reserves through the first half of 2024. Retired wealth manager Clive Thompson discusses the rising gold prices, which he attributes to increasing government debt and the looming risk of inflation. According to Thompson, a broader central bank shift toward gold is inevitable, inspired by China's lead, despite potential delays from institutional processes. He observes a rising preference for gold as concerns grow over the diminishing value of fiat currencies and treasury bonds. Although gold's performance against the US dollar is impressive in itself, analysts note that the global currency market shows broad-based strength in gold. This past week, gold hit fresh all-time highs against major currencies like the euro, British pound, yuan, Canadian dollar, and Australian dollar. While reflecting on the current market, Thompson warns of skyrocketing global debt, fueled by overspending since 2008 and the COVID-19 pandemic. He predicts governments will refinance low-interest debt at higher rates, sharply increasing interest payments. Within 10 to 15 years, some could face interest costs surpassing tax revenues. Conclusive evidence shows that U.S. national debt has ballooned from $5 trillion to $35 trillion. Gold prices have risen by 10 times since 2000. That's a whopping gain of over 826% since the beginning of the century. Based on his assessment, Thompson analyzes growing interest in gold as a safe haven due to fiscal instability. He links gold's rising price to its appeal as a plan B for wealth preservation. We present the clips of Clive Thompson's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Government debt is rising faster than it's ever risen in history. It's not just the USA, it's around the world. Governments have got into the habit of overspending, starting with the global financial crisis when they bailed out all the banks. And then we went through the COVID crisis where they printed money willy-nilly to help all those people who were furloughed or lost their jobs and that sort of thing. And having got into the habit of spending money, not only on those types of things, but other things as well, for a while, there appeared to be no negative impact. So these habits of spending more than they're collecting in taxes continued and have got worse. Now, I'm talking about democratic countries here where it's very difficult for a politician to put his hand up in the air and say, all those benefits we were giving out last year, we've got to stop it now. So cutting the spending is very difficult. There'll be rioting on the streets if you try to do that. Raising the taxes, they're trying to do that, but you can only go so far. If you raise taxes, it stifles economic growth. In the end, the result of that will be lower taxes anyway. So there's not really a very easy answer, but the debt is rising quite fast. We've got interest payments on that debt rising much faster. And the reason for that is that a lot of that debt, which was taken out over the last 10, 15 years by governments, was taken out at a time of zero interest rate policy, ZIRP, Z-I-R-P. So that meant that the interest they were paying on the debt was very low. That debt is reaching maturity little by little over the next decade. So as it matures, they have to borrow the same amount again, plus all the interest, but they're borrowing it at a much higher interest rate. So the interest is rising fairly rapidly. And that means, when I say fairly rapidly, I mean it's quite dramatic. And there's a real possibility that within 10, 15 years, the interest payments by governments will be exceeding the totality of their tax take. That's a possibility. Certainly it will be happening if nothing changes by the time my children get coming into retirement. So I don't think there's a lot of hope for the next generation in terms of being able to repay that debt. I think the governments are going deeper and deeper into debt. They don't have a way out. They don't know how to get out, and I don't know the answer. So, where's it all going to go? And I think people are saying, I'm not going to get paid back in something which will buy me something. There's so much of it. So I think people are saying, gold is my plan B, it's my parachute, and they're buying some gold to store value. And of course, we've got the central banks now seeing the same thing. We've had quite a bit of buying last year from countries like Poland, and obviously China was one of them. And I think although China wasn't the biggest buyer of gold last year, I think Poland was, people are taking their lead from China, who in the month of December bought twice as much gold as they bought in November. In November, they had, that was after a several month break when they hadn't bought any gold. But the increase in China's reserves over the last 12 months, 80% of that increase has come from gold itself. A mixture of buying gold and the rise in the gold price. Now, what that's saying, China is buying gold, and gold's at an all-time record. They are valuing gold more than any other asset they could buy. So I think other central banks are taking notice, and it'll take a long time for central banks to react to this, because, if you're going to increase your gold holdings in any central bank, you've got to have your legal department on side, you've got to have the compliance department on side, the risk department on side, the management on side, the investment department. There's going to be all these different departments, the economics department, who've got to be consulted, brought on side before they start to buy gold. But little by little, I think other central banks will be following suit in the wake of what China's doing. And I think those who can see that that is coming are saying, well, I don't want to be the last one to the post. So they're starting to buy today. And that's why the gold price is rising, despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East. People are saying none of that matters, because what really matters is, what am I going to get back if I go for the other thing I could buy, which is treasury bonds? What will they give me in 10 years or 20 years? Will I be able to buy something with them?
In the interview, Clive Thompson discusses recent shifts in sentiment around U.S. interest rates, noting fluctuations based on inflation data and Federal Reserve statements. While recent positive inflation figures support the possibility of 2 rate cuts this year, he cautions that rising oil prices and potential reinflation could reverse this trend. President-elect Donald Trump created a headache for the Federal Reserve before he even stepped into office. Inflation, part of the Fed's dual mandate of maintaining price stability with maximum employment, remained a challenge throughout 2024, with price increases approaching, but not breaching, the Fed's 2% inflation target. Based on fundamentals, Thompson predicts central banks may collectively revise their inflation targets from 2% to 3%, acknowledging the difficulty of achieving the current benchmark. According to updated economic forecasts from the Fed's Summary of Economic Projections published in December, the central bank sees core inflation hitting 2.5% next year, higher than its previous projection of 2.2%, before cooling to 2.2% in 2026 and 2% in 2027. Let's get back to the interview.
Sentiment has been swinging 2 ways, or 3 ways, I suppose, in the last few weeks. When they last cut interest rates in December, the view was we'd get 2 more cuts this year. Then, as the bond yield started to rise, sentiment started to change, and actually there was some words coming out of Fed saying we're not in such a great hurry to cut rates. So sentiment started to change a little bit along the lines of it might take longer before they cut them, and we might not even get those 2 cuts. But recently, just last day or two, we've had some very good inflation numbers in the United States, and the 2 cuts this year are back on the table. Of course, the Fed can do what it likes at the short end. It can, that's what it controls. It doesn't control the long end unless it steps in with quantitative easing, buying government bonds. So really, the short-term interest rate is what's under the control of the Fed. If they want to reduce it now, they can. They've got full justification for doing so on the grounds of those recent inflation numbers. So I think it's likely they will while they can, but whether it be 1 or 2 cuts, we'll see. But I think after that, people will be starting to talk about short-term interest rate rises again, if there's some sign of inflation resuming. And there are early signs that might be coming back. We're seeing that the oil price in recent weeks is ticking up quite sharply. And of course, any escalation of tensions will cause supply chain bottlenecks for the shipping routes. So we've actually removed the bottlenecks we had a year and a half ago, 2 years ago so we had higher prices a year or 2 ago because of the war in Ukraine as things started to seize up a little bit. And then there was the the COVID before that. So we're coming out of that. So these higher prices are coming off their peaks, so which means we've had up until now the benefit of, when we look back a year, looking back over 1 year at peaks. So we're obviously in many products lower than we were a year ago, but having seen that decline, we're no longer at peaks. So when we look forward a year, it's quite possible that the prices will be up and rising again. There's no hill to come down anymore. We've come down the hill. So can it go down the hill further? I think it's much more limited now. So yeah, I think inflation will be coming back, and I think the Fed at that point will have to be thinking about what it does. Will it change its 2% target? I think it will. I think it will probably change the 2% target to 3%. It won't be alone. I think the whole world will do that. Currently, they're sort of sitting at 2%, but looks like it's an unachievable target. So I think we'll probably see some sort of collective decision as they gradually, central bank by central bank, say our new target is 3%.
Gold continues to demonstrate consistent growth, driven by robust macroeconomic factors. The upward trend is evident across all time frames. Even though short-term fluctuations cannot be ruled out, the precious metal can climb to the long-term target of $3,200 to $3,400 in 2025. How do you think rising global debt and inflationary pressures will shape the demand for gold in the years ahead? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.